Go through the Chapter 9 handout, kind of moving back and forth between the PowerPoint and the handout. So you can pause it and just go to the places where you need help at. So I'm going to move through the handout chronologically from the beginning to the end, so if you need to fast forward it. But what are some characteristics of fixed assets? So I'm assuming that you've read it and you know that fixed assets are tangible, you can touch them. In other words, they're not intangible. Intangible assets, things you cannot touch, such as copyrights, patents, those items that we have a legal system to defend because you can't touch them. They're owned and used by the company in its normal operations. And this is combined with this. They are not offered by sale or as part of normal operations. In other words, this one, fixed assets are not inventory. So a car can be a fixed asset for a lot of businesses, but for a car dealership, it's inventory. And this one, used in its normal operations. Land can be used in a business if I have my plant site on it, but I can also buy land and hold it as an investment. So land held for an investment would not be a fixed asset. The next one, any assets that, the normal answer to this, any asset or any cost to get the asset ready for its intended use is added to the cost of the asset. So think about a building. Before I use it for the first time, I add it to the cost of the asset. So you can look through those and see that all of those are incurred before I would use the building for the first time, or incurred in building the building, which would be before I've used it. Machinery and equipment, any costs that I would incur to get it ready for running the first item on it I intend for sale. So you can see that I can also have testing. So if I utilize my regular inventory for testing, but I scrap it, it's added to the cost of the asset. And land also, anything that I take to get it ready for its intended use. So if my intended use is to build a new building on it, then grading and leveling the land or removing an old building, less any salvage value, would be added to the cost of the land because my intended use was to build a building on it. So we can go through one of these. Let me pause it. Okay, so we operate a printing press, so I want to know what's going to be added to the cost of the printing press. I'm just going to add them up over here. So $40,000 is definitely added to the cost of the asset. Fee paid to the factory representative for installation. Again, I add it to the cost because I haven't used the printing press for its first time. Freight is definitely a cost that I would need to add to get the asset ready for its intended use. Insurance while in transit. Note if it was insurance after I'd installed the printing press, that is different. That would be insurance expense. But before I've used the printing press, it's part of the acquisition. New parts to replace those damaged during unloading. I didn't intend or plan on having that, so that's a repair expense. So that one would go to repair expense. Sales tax on the purchase price. I believe in your handout I had it at, okay, I believe I had the sales tax at 5%. I forgot I didn't write it on this one. But anyway, let's assume it's 5%. If it's not, I apologize. And then a special foundation is also added. So I've got $47,800. So I'm going to debit printing press. And I'm going to credit cash or whatever I pay for it. So my entry is $47,800. And notice this is the amount I depreciate. All of these numbers are in essence gone. There might have been a worksheet someplace, but I will never use these numbers again. I have a printing press for $47,800. So this one I have $20,000 to cost of the new machine. Fees paid to attorney. Again, I have to spend that to get it. Freight, all cost installation, all costs to get the asset ready for its intended use. Replacement of worn out parts. I've got repair of damage incurred in reconditioning the press, $500. Again, it's damage done. I wish they would have been a little clearer that that item happened after you purchased it. Replacement of worn out parts. I intended to do replacement before I bought it. It wasn't a mistake, it wasn't damage. And vandalism repairs during installation. Again, not part of what I bargained for when I bought it. So my cost of this printing press is $22,200. In this case, I would debit printing press for $22,200 and credit cash for $22,200. And like the other one, I would depreciate $22,200. These costs have all disappeared. Okay, this one, I have Bridger Ski Company had developed a tract of land as a ski resort. They've cut the trees, cleared, graded the land hills. Should the tree cutting, clearing, grading costs be debited to the land account? Yes, because it is part of the cost to get the land ready for its intended use. And should the cost be debited to land be depreciated? And the answer is no, land is not depreciated. But if it was a depreciable asset, then it would indeed be depreciated. Okay, so this one, we acquired adjacent lot to construct a new warehouse, paying $100,000 and giving a short-term note for $700,000. So in this case, I would add the $100,000 cash I paid for it, and I have the $700,000 note. So just like some of the homework problems that you have done, where you would debit warehouse, credit cash, credit notes payable for that. Legal fees were $5,000, so again, that's a cost to get the asset ready for its intended use. Next one, delinquent taxes assumed were $18,500, and fees paid to remove an old building from the land were $12,000. Again, the intended use of the land is to put a building on it. Materials salvaged from the demolition of the building were sold for $4,000. So basically, I'm going to net that with this. So these two I would actually net together. It cost me $8,000. I recouped some of the demolition costs by selling them. And a contractor was paid $950,000 to construct a new warehouse. I didn't leave enough space, but I don't put anything in there for that anyway. That is would be debited to warehouse, not land. So it's an easy mistake to make to put it in there. But it is capitalized, but to the warehouse, not to the land. So my land is $831,500. Okay, this one I've got. I want to see if they're added to land improvements, building, or other. So I'll just kind of go as I go along. Fee paid to attorney for title search. That is added to the cost of the land. Next one, real estate taxes. Cost of real estate acquired as a plant site, land and buildings. Well, if you look down in D, so even if you put it in the wrong place for B, if you got down to D, you'd see that I removed that building. So I'm going to put these both in the land because I'm going to use that land to build a building on it. So the building just gets demolished and added to the cost of the land. Delinquent real estate taxes on property. So again, that's added to the cost of the land. Next one, cost of raising and removing the building. Don't put that in the building. That is the cost of the land is the intended use is to put a building on. So until I start digging the foundation, I'm going to add that to the cost. Next one, proceeds from sale of salvage materials of the building. So that one's recouping of the cost. So I'm going to deduct that from the $5,000. So notice it only cost me $1,000 to raise the building. Special assessment paid to the city for extension of water main to the property. That's added to the cost of the land. The water main is actually owned by the city, so this is a special assessment is in essence a real estate tax paid to get that water main extension. Architects and engineers fees for plans and supervision. I kind of wish they had indicated whether this is on the land or the building, because you can certainly hire architects and engineers for grading the land, sloping the land for water drainage, etc., etc. But I believe this is for the building, and I'll have solution in front of me. But premium on 1 year insurance policy during construction. So that's on the building since I'm building the building. Next one, cost in filling and grading the land. I'm going to put that on the land. Money borrowed to pay the building contractor. Most of the time you would think that that would go into the building, and indeed you might put it there initially, but we're just borrowing money. So your entry is actually debit, cash, credit, notes payable. So I'm going to put it over here in other, and it's going to be in notes payable. Next one, cost of repairing windstorm damage during construction. So again, that was not expected. So I'm going to have $5,500 in repair expense. Next one, cost of paving a parking lot to be used by the customers. That is land improvements. Next one, cost of trees and shrubbery, land improvements. They have a life. You will depreciate them. Cost of floodlights is land improvements. Next one, cost of repairing vandalism during construction. Again, it was not expected. Next one, proceeds from insurance company for windstorm and vandalism damage. Notice I'm going to put it in other. You'll either put it in other income or you'll net it against these two repair expenses. Payment of the contractor. So here's where it goes to building. So notice this is, if you put this one in building, you would be actually double counting because you borrowed the money, now you're paying them. Interest incurred on the building loan during construction. So since I'm building it, it's added to the cost of the building. And refund of premium on insurance policy canceled after 11 months. So I go back up to H, the 6,000, and see where I put the 6,000 there. And I put the 6,000 in building, so if I got some of it back, I'd need to take it out of building. So let's actually take out 500. Okay, so I can add all these. See there, our land account has 400,000 as long as I typed in my numbers right. I didn't add up the other column because they go to different accounts. One thing that is just not going to have you do it, you just need to know that while I'm building the building, so in this one, while I was building the building, the actual title should have been construction in progress, and then when I got done, I took it to, then when I got done, I took it to the building. Okay, so I've jumped forward quite a few slides. I guess we're on slide number 62. So what's a capital versus revenue expenditure? What are the three entries? So basically a revenue expenditure benefits the current period. Most of the time when you have a revenue expenditure, you would debit repair expense. There are other things that you can have, like advertising expense. You put your name on the side of the truck. But for the most part, you spend some money fixing an asset. Is it just a repair, or is it big enough that you have a different asset? So your three entries are, the first one is repair expense. So the first one is repair expense that you can have. So you'll debit repair expense and credit cash. So there's an example. The 300 for the tune-up, and you can see this there. So capital expenditures can either, there are two things. They can significantly increase the asset's value or significantly increase its useful life. So if it increases its useful life, you want to debit accumulated depreciation. So an engine of a forklift is near and it's overhauled. So in this case, I debit accumulated depreciation. Notice accumulated depreciation is a contra asset, so its normal balance is credit on this side. However, when I debit it, I'm in essence getting some of that life back. So that's what this one. And the last option is if you significantly improve the asset, then you debit the asset itself. So you can debit delivery truck. Okay, the next question is, what is a capital lease? A capital lease is in essence a purchase of the asset. So for instance, if you leased a $10,000 car for 5 years and paid $2,500 a year for it, so notice 5 times $2,500 is more than $10,000. Have you bought the car or have you leased it? And the answer is you've really bought the car. And in that case, we want to put the asset on our books as an asset. So I would debit leased car and credit cash for the value of it. An operating lease is a regular lease where I would debit depreciate or debit rent expense. Okay. The next one, what is depreciation? One thing that I like to call depreciation is the systematic allocation of the cost of the asset over its useful life. So in other words, in this one, I need to spread that $24,000 cost over the 5-year life. So it's like prepaid insurance that I would allocate over 6 months if I bought a 6-month insurance policy. But in this case, I need to spread the cost over 5 years. That is called depreciation. Notice land is not depreciated. A couple things that why you depreciate it. Basically, you can have physical depreciation. It does wear out. You can also have functional depreciation. It still works, but nobody uses it anymore. Technology has increased and made it really not usable. Okay, make sure that you do know that depreciation does not measure decline in the market value of a fixed asset, and it provides no cash to replace the asset. The cash went out the door when you bought the asset. So what do we need to know about it? Most of you have done depreciation, and even if I said you had a $10,000 car that was going to last you 5 years, how much do you depreciate a year? Most of you would say 10,000 divided by 5 is $2,000. I'm just going to throw in one extra thing about it, and that's residual value. So notice this one is 24 and it's got a residual value of 2,000. So in other words, my estimate of its decline in value is 22,000. So I only want to depreciate the $22,000. Okay. Again, if I go back to the page, the first page that I did here, I'm going to depreciate. See if I still have it. I am going to depreciate the $47,000. If you go back to this, I'm not going to depreciate the $40,000. I'm going to depreciate the amount that was in the journal entry. I don't recall what that was right now. But that's my cost, not the $40,000, the total up there. These are the 3 methods we're going to do: straight line, units of activity, and double declining balance. Notice I call it units of production. It's the same thing. So we're going to go through all of them, and I have a couple other videos on those too. So the straight line method, you simply take cost minus residual value divided by the life. So in this case, it's cost had a life of residual value of 2,000 divided by 5 years is 4,400 a year. So I want my depreciation. Notice you can take 1 divided by 5 and get 20%. That's all that's saying. So I debit depreciation expense and credit accumulated depreciation every year for 5 years. 5 years, yeah. It's my journal entry. So what is the book value after 2 years? So my book value after 2 years, book value is cost minus accumulated. Notice I do not take the salvage value when I compute my book value. So cost minus accumulated depreciation is book value. So my accumulated depreciation after year 2, so I did $4,400 of depreciation the first year. Look at the journal entries you just wrote down, plus $4,400 for the second year. And so I have $8,800 for accumulated depreciation. And so I have cost minus accumulated is 15.2. So notice if I did another year, my book value goes down to 10.8. If I add another year, 17.6 or 6,400, and if I do another year, 2,000. So in the last year, so I did 5 years there. 1, 2, 3, 4, 5. After 5 years, my book value should be equal to my residual value, and that's important to remember on all of these. So the next thing we're going to do is double declining balance. In double declining balance, the assumption is we use up most of the value of the asset in its earlier years. So I want to take more depreciation expense in the early years. Some people also say it's the assumption in the early years I should take more depreciation expense because in the later years I'm going to be spending more on repairs and maintenance to keep it up to the usage of the first year. So at any rate, I'm going to front load my depreciation up front. So double declining balance is twice the straight line rate. So the first thing I need to do is figure out the straight line rate. So my straight line rate is 1 divided by the life, in this case is 5. So 1 divided by 5 is 20% times 2. So I'm going to get 40% is my depreciation. Okay, had to have enough decimal places there. So in year 1, so this is actually year 0. So when I buy it, my book value is $24,000. Cost of $24,000 minus accumulated depreciation is 0. Again, I don't use salvage value and book value. So for my depreciation expense, I'm going to take 24,000 times the 40%. So I have 9,600. My accumulated depreciation is 9,600. My book value is now my cost minus my accumulated depreciation. The next year, I'm going to take my book value times 40%. So notice it's declining balance. So I have 5760. So my accumulated is those two together, and my book value is 24,000 minus my accumulated. So this is year 1, 2, 3, 4, and 5. So in year 3, it's my book value times 40%, so 3456. So my accumulated is adding up all of those, and my book value is again reduced. So in year 4, book value times 40%, and my accumulated, all the prior years, and my book value again keeps going down. Now in year 5 is kind of the unique year because I would take this times 0.40%, but notice that my accumulated depreciation is 22 and my book value is 1186, and I know that my book value at the end has to be 2,000. So in the last year, the book value is, the depreciation expense is actually a plug figure. So I want this to be 1 because I want my accumulated to be 22,000, which is cost minus accumulated, or cost minus salvage value. I want to depreciate at 22,000 because I want my book value to be 2,000 in the end. If I purchased it on October 1st, hold on, it looks like I skipped the straight line October 1st and I skipped the units of production. So we'll come back to those in a little bit. Let me finish this. So let's say this is the chart over here, but compute year 1 and 2 depreciation if it is purchased on October 1st. So in year 1, I have, again, book value times 40%, but in this case, I'm going to take it times October, November, December, 3 divided by 12. So I have $2,400 of depreciation the first year. My accumulated then is $2,400, and my book value is the 24 minus the 2,400, etc. Then the next year, notice I have this in an Excel spreadsheet, so it kept changing them. So I just do the same thing. I take the 21,600 times 40% to get 11,400. So my compute year 1 and 2 depreciation is 2,400 and 8640. So let's go back to straight line if I had purchased it on October 1st. Okay, so for straight line, we had the cost minus the salvage value. So it's 22,000. So that divided by 5 years, divided by life, is 4,400 a year. And so since I purchased it in October, times 3 divided by 12, so I would have 1,100 in the first year And the next year, since I owned it all 12 months, it would be 4,400 in the second year. So unlike double declining balance, notice I could just pull this, but be careful in double declining balance because you always compute it based on book value. So my book value at the end of the first calendar year will be different depending on the number of months I had it. All right, so let's go back to units of production. In units of production, it is very similar to straight line. I take my cost minus my salvage value. So I have $22,000. Okay, and so I take my cost minus salvage value divided by life. But in this case, my life is in hours or miles or whatever in the heck you're going to use for your units of production or units of activity. And so it's useful life of 10,000 hours. So I have 22,000 divided by 10,000 hours. So I get 2.2 per hour. Okay, so if it's 2.2 per hour, and if it was operated for 2,100 hours, so I have $4,620 in the first year, $1,500 in the second year. Something tells me this is an old handout. So if it's $1,500 in the second year, I have 1,500 times 2.2. So notice I don't have what if it was purchased in October on this one, simply because you don't need it. This one is 4,400 per year, so if I have a partial year, I need to take part of it. This one's 2.2 per hour. So in year one, if I used it less hours, it would just be a smaller number. So don't prorate units of production. So my book value after 2 years is, as long as my numbers are correct here, 1,500 in year 2, 2,100 in year 1. Yep. Okay, so my book value is cost, so 24,000 cost minus accumulated. My accumulated is 4,620 and 3,300. So cost minus accumulated is 16,080. So again, it's the my cost minus my accumulated depreciation, 16,080.